Welcome to The Explainer. Today, we're going to dive deep into something called technical analysis, which is really the art and science of reading the market's mind. We're going to uncover how analysts can look at nothing more than a price chart and interpret the collective feelings of millions of traders. It's this fascinating mix of crowd psychology and cold, hard data.
So let's just get this out of the way. Is this whole thing just a fancy way to read tea leaves? I mean, a lot of people see analysts with all their charts and patterns, and they can't help but think they're trying to predict the absolute future. But is that what's really going on here?
That's a really common misconception. The best way to think about it is less like a crystal ball and more like a weather forecast, right? A meteorologist uses data to say there's an 80% chance of rain. They're not saying it will rain with 100% certainty. Technical analysis works the exact same way. It is not about being certain. It's all about using what happened in the past to figure out the probabilities of what's likely to happen next.
So the crucial point is this. We're not trying to be oracles. We're just trying to be interpreters. See, every single transaction, every little price move up or down, it's a clue. And when we put all those clues together, we start to get a picture of the market's collective emotion. Is it fearful, greedy, confident, indecisive? We're essentially reading its body language.
Okay, so how do analysts actually pull this off? Well, here's our roadmap for today. We're going to start with the big picture, then learn the visual language of the charts themselves, look at the specific tools analysts use, and finally, we'll put it all together with a real-world example. So, let's get started. The first, and you could argue the most important rule of technical analysis is to always start from the top down. A professional doesn't just wake up and randomly look for promising stocks. No, first they need to understand the environment they're in. Are we in a storm or are we sailing under clear skies? This top-down approach is what helps them filter out all the noise and focus on the highest probability ideas. You've probably heard that old saying, a rising tide lifts all boats. Well, that's the absolute core of the top-down approach. If the overall market is feeling strong and is in a buying mood, even average stocks can do pretty well. But trying to find a winning stock when the whole market is sinking, that's like trying to swim against a really strong current. So step one is always figuring out which way that tide is flowing. So, how do we check the tide? Well, we look at the market's vital signs. The major stock indices like the S&P 500 or the NASDAQ. Think of these as our barometers for market health. By analyzing their charts first, an analyst can get a really clear sense of the overall sentiment. Are the buyers in control or are the sellers? This first step is absolutely crucial because it sets the context for everything else that follows. All right, so once we've figured out the overall market direction, we can start to zoom in a bit and learn the visual language of the charts themselves. And this is where we learn to spot one of the most fundamental concepts in all of technical analysis, the trend. Okay, this is the formal definition, but honestly, it's way simpler than it sounds. An uptrend isn't just a line going up. It's a very specific, almost rhythmic pattern of movement. The best way to think of it is like climbing a set of stairs. Each step up is a new high, and the landing right before it is a new, higher low. Now, this slide breaks down exactly how you can systematically confirm an uptrend. You don't just guess. First, you start at the current price and you go backwards to find the most recent peak. Then, you find the peak before that one. Is the new one higher? Okay, that's your first confirmation. Next, you do the exact same thing for the valleys. Is the most recent valley higher than the previous one? If you get a yes on both of those questions, then you have a technically confirmed uptrend.
And of course, the exact opposite is true for a downtrend. Now the market is walking down the stairs. It's a series of peaks that keep getting lower and valleys that are also getting lower. This systematic check, it helps us take our emotions out of it and just see the trend for what it actually is.
Now, beyond these simple up and down trends, the market forms more complex shapes, or what we call patterns. And these patterns are just fascinating because they're basically visual representations of the psychological tug-of-war between the bulls, who want prices to go up, and the bears, who want them to go down. A great example of this is how many patterns have a direct opposite. Take the double top. Here, the market hits a high, it pulls back, and then it tries to rally again, but it fails at that same level. This M shape is a sign of exhaustion. Some traders even have a dark little joke that M is for murder because it can kill an uptrend. And on the flip side, you've got the double bottom. It looks like a W, where the market finds a floor twice, signaling a potential win for the buyers.
And this happens with so many of the common patterns. You have the head and shoulders pattern, and its opposite, the inverse head and shoulders. You have an ascending triangle and a descending triangle. These aren't just random shapes on a screen. They are recurring stories of market psychology that analysts learn to read over time.
All right, so once we get a handle on the raw language of price, the trends and the patterns, we can start to bring in some more advanced tools to add a little depth and confirmation to our analysis. The pros tend to organize their toolkit into 3 main buckets. First up is what we've already covered, pure price action. Second, you have what are called Western indicators, which are basically just mathematical formulas that analyze price and volume to give us a different perspective. And third, there are other measurements that can tell us about things like fear or complacency in the market. Let's look at a classic example, the MACD. Now, the full name is Moving Average Convergence Divergence, which sounds really intimidating, right? But the concept behind it is actually pretty simple. It's built using moving averages, which are just lines that smooth out all that jagged day-to-day price action so we can see the underlying trend more clearly. So really, the MACD is just a momentum gauge. It helps us answer the question, is this trend speeding up or is it slowing down? Think of the 2 moving averages it uses as 2 cars on a highway. When the faster car is pulling away from the slower one, that's divergence, and it signals that momentum is growing. But when they start getting closer together again, that's convergence, and it's a warning that momentum might be fading.
And this is a really, really important point. You'll hear analysts out there throwing around dozens of fancy-sounding terms: Fibonacci retracements, Elliott wave theory, stochastic oscillators. But the goal isn't to sound smart, it's to understand the story. A good analyst uses just a few tools that they understand deeply, rather than 100 that they only kind of know on the surface.
So, we have our philosophy, we've got the language, and we have a few tools. Now let's actually put it all together. We're going to walk through a complete top-down analysis just to see how an analyst might use this process to find a potential opportunity.
Okay, so here's a practical example. Step 1, the broad market. We check the S&P 500 and confirm, yes, the overall tide is rising. Step 2, the sector. We find that the technology sector is one of the strongest parts of the market right now. Step 3, the stock. Within that strong sector, we find a stock that's forming an ascending triangle pattern. This pattern, with its flat top and a rising bottom, tells us that the buyers are getting more and more aggressive. And finally, step 4, confirmation. We get a signal called a golden cross. All this means is that a short-term trend indicator has crossed above a long-term one, which suggests momentum is picking up to the upside. And this whole process, from the broad market all the way down to a signal, that's how analysts narrow their focus.
This brings us to our final and honestly our most important point, having the right mindset. Because understanding what technical analysis is not is every bit as important as understanding what it is.
So many people get stuck in this endless argument, which is better, fundamental analysis or technical analysis. But smart investors know that's completely the wrong question. They're not competing, they're complementary. Fundamental analysis helps you answer the question, what should I buy? By finding strong, healthy businesses. Technical analysis helps you answer, when should I buy? By identifying the right moments based on market sentiment and price action. They're really just 2 sides of the same coin. And that's really the key takeaway here. A chart isn't just a line on a screen. It's a footprint of human emotion. It's a story of hope, fear, and greed, all playing out in real time. The real art of technical analysis is learning how to read that story. It gives you a framework to cut through all the noise, to ask what the market is feeling, and to start interpreting that answer for yourself.